Hey guys, we are back with video number 10 in the series. Today we're doing XRMI. We previously did these 9 ETFs, and this is a series where we take a look at how much of each of these ETFs we need to own, how big our portfolio needs to be able to hit that $1,000 a month. What we do in these videos is we go over to the web page and try to determine what they are doing to be able to pay us that dividend yield. How are they reaching those dividend yield numbers? We go over to Seeking Alpha and check out the historical dividend yield to try to come to one number to be able to determine our $1,000 a month in dividends. And then we compare the fund in question or the ETF in question and compare it to an S&P 500 index fund. Today's ETF is XRMI. XRMI is Global X's S&P 500 Risk Managed Income ETF. So what does that mean? XRMI seeks to generate an alternative source of income by selling covered calls. So what's a covered call? So over here on Investopedia, they have a pretty good definition of what a covered call is. I just want to highlight a few things. So for a covered call, to execute a covered call, an investor who holds a long position in an asset, meaning you own at least 100 shares of an asset and you are expecting to hold the 100 shares for a long time, you sell a covered call, meaning you give a buyer the right to be able to buy your 100 shares of the same asset to be able to generate some income. So that buyer will pay you a premium. You think that the shares are going to stay flat or go down, but you want to hold them for a long time, and the buyer is expecting the shares to go up. There's a few things I want to highlight right here. I won't highlight all 5 of them, but to be able to execute a covered call, an investor holds a long position in an asset and then writes or sells covered calls in the same asset. Ideally, this strategy is for investors who believe the underlying price will not move much over the near term. If it does go up, then you might have to actually sell your 100 shares to the buyer, but you still are able to collect that premium. So that's, in a nutshell, a covered call. Back to XRMI's webpage. XRMI also buys protective puts to mitigate the risks of a major market sell-off. And then, of course, XRMI expects to make distributions on a monthly basis. So what is a protective put? Well, a protective put is a risk management strategy using option contracts that investors employ to guard against the loss of owning a stock or asset. The hedge strategy involves an investor buying a put option for a fee called a premium. So in a nutshell, the protective put acts as an insurance policy by providing downside protection in the event the price of the asset declines. So to be able to generate those dividend yields, XRMI is selling covered calls and buying protective puts. So let's go over to Seeking Alpha and check out what type of dividend yields they are actually producing. So XRMI has only been around for about a year or a little over a year. So they have had 12 dividend payouts, just 12 and 12 only. So their 12-month trailing yield is 11.58%. Let's take a peek at what those payouts have looked like. So we can see that their payouts have been anywhere from 15 cents all the way up to about 25 cents. So that equals to be about an 11.5% dividend yield. So coming over to our compound interest calculator right here, we're going to determine how much of XRMI we need to own. So we're just going to focus on a few areas of this calculator. XRMI is the fund we want to take a look at, that we determined that their dividend yield was around 11.5%, and we can flex on this number as well. Their expense ratio is 0.6. We're not going to play around with the growth and contribution numbers, but if you did have a monthly addition of $1,500 a month in XRMI with pretty much a flat annual growth, with reinvesting dividends with a $1,000 initial deposit, this is about what you could expect with XRMI in about over the course of 10 years. And this is the dividend yield that you would be reinvesting in the fund over the course of 10 years. But down here, this is what we're looking at. With that 11.5% yield XRMI, you would need $104,000 to hit that $1,000 a month in dividends. You would need $10,000 to hit that $100 a month in dividends, around $500,000 to hit that $5,000 a month in dividends. So last but not least, let's go ahead and see how XRMI has compared to SPY, or an S&P 500 index ETF. This is Portfolio Visualizer. We're taking it on a month-to-month basis with $500,000 invested. We're taking a look at if we were to reinvest that 11.5% dividend, and I think SPY is a 1.5% dividend yield. We analyze it and take a look since the inception of XRMI with that $500,000. If you go all the way over here in the blue, you can see XRMI with dividends reinvested would have outperformed the S&P 500. So we have been in what they call a bear market or a recession. So XRMI, the CAGR number overall is about a negative 10%, where SPY is about a negative 11%. Let's take a look at if we were not to reinvest the dividends. Let's analyze the portfolio. If you were to be pulling out the dividends and paying yourself with $500,000, XMRI versus SPY, you can see that SPY would have overtaken XRMI as you would be paying yourself those dividends. So the price CAGR, cumulative annual growth rate, your XMRI portfolio balance would have been reduced around 18% over the course of the year, $409,000, and SPY $500,000 balance would have been reduced to about $437,000. But what type of income would you have received in that time period? We come down here, portfolio income. In 2001, your $500,000 in XRMI would have paid you $14,000, and your $500,000 in XRMI in 2022, so far this year, September 2022, would have paid you $33,000. So with that, that concludes XRMI's ETF analysis. You'd need around $104,000 at that 11.5% dividend yielding number to hit that $1,000 a month. If you guys do not see an ETF on this list that you would like me to analyze in this way, go ahead and comment down below the video. We already have two comment suggestions, SVOL and SDIV. So head down to the comments and let me know what other ETF you want analyzed in this way if you don't see it on this list. And with that, thanks for watching.